Okay guys, so gone through the European close of course, and just going to wrap things up, probably have a look at a couple of key market themes for this week before we kind of sign off, and I'll let you guys crack on with your weekends. But obviously the big event of the week was undoubtedly the ECB, and I guess looking at the euro, the move is by far the most pronounced still. And obviously we briefly breached 117 in the euro currency earlier in the session, which is quite a milestone as far as the euro goes. I mean, just looking on a daily continuation here, if I just modify the chart, maybe just move some of these studies. So looking at the euro currency, obviously where we are at the moment on the daily continuation, we're pretty much to the T, testing a very key level. We obviously earlier immediately after the press conference with Draghi, we managed to get above that 2016 high, and here we are now testing pretty much to the T that 2015 high. So an incredible rally that we've had in play from really the middle of April all the way up, kind of I guess political risk diminishing in Europe, the ability of Macron to kind of bring a bit of unity at least with Angela Merkel to the European situation, some of that populist movement across the Eurozone maybe dissipating slightly, and then in combination now this slight pickup that we had in inflation, albeit it's tailed off slightly more recently, but then it's allowing the ECB to turn more hawkish. Economic improvements in the euro area have all led to economic data showing some underlying improvement, and that's been encouraging enough for Draghi to turn, if we go back shorter dated, more optimistic about the economic outlook. And one of the biggest things that we had, if we look at, so 60-minute chart of the euro, and if I actually go a little bit longer dated, there's a couple of key points really where the euro's taken a really decent move in the last month or so. And really that was the bigger move, actually, was the initial ECB forum held in the Centra speech in Portugal, which is when Draghi didn't really lay concrete signals as to what he's going to do from a policy perspective, but sounded bullish enough about the prospects for the euro area economy that ultimately this era of accommodative policy is soon going to come to an end, and the euro saw very aggressive repricing. If we were mapping this against the German benchmark Bund, then yields would follow the path of the euro, and Bund's gone the complete opposite direction over that period. And then what's happened is this latest ECB press conference is, given the revaluing of the euro in particular, having traded from really a mid 112 handle up until a breach of 116 going into the ECB event yesterday, obviously a lot of people thought, well, maybe Draghi might start to unwind a little bit of this hawkishness that the market's repositioned itself for. And what we heard yesterday was really the opposite. He didn't say anything different. He, in fact, just repeated largely what he said. And so hence we had such a good move, appreciation in the euro currency to the upside, and we even added to it a little bit to briefly breach 117, albeit that's roughly acted as a bit of a barrier for price action throughout the session today. The other thing to keep in mind though here with the euro move, and just going back to the daily chart to look at it, and as you can see here, this upward trend of the euro has been pretty consistent. The other thing here is dollar weakness. You know, we're trading a sub 94 handle in the dollar index at the moment. Now, we have seen economic data in the US start tailing off slightly, but more notably, certainly yesterday's session was a bit of a dual situation here. If I just highlight the actual timings, because yes, the catalyst was, and probably by a weighted basis, more so Draghi, but then you had the renewed speculation and sources commenting about Donald Trump and the expansion of probes into his business transactions and his dealings with Russia and so on and so forth. That spooking the market and equating to dollar weakness. We saw that as well with equity markets remaining under pressure, and one could argue that today's session has been pretty quiet really from a macro point of view, but maybe some Trump fears lingering in the marketplace. You've also had a couple of earnings, of course, this week, two that really spring to mind of a negative side of things are IBM. They had their 21st consecutive quarterly decline in their revenues. They obviously are a large weighted stock, as to General Electric, whose shares were down as much as 4% following their earnings earlier today. So earnings season hasn't completely been plain sailing by any means. There has been some more brighter spots, but certainly some of these large cap names have also captured some attention, as well as the banking sector. We've pretty much wrapped up most of the US big Tier 1 banks that have reported, and yes, Morgan Stanley finished on a high note, exceeding expectations across all departments and divisions. But Goldman Sachs in particular, and some of the others like Bank of America and so on, had a little bit of weakness apparent in their core businesses, and especially their fixed income currencies, commodities trading and arms as well, which was a bit of a surprise. So a couple of things on that side of that side of the market that have been quite interesting. The other thing that's obviously been in vogue today, and I actually think does change up the picture slightly for the near term, i.e. the next coming weeks and months, is for sterling currency. Now, if we look at the pound on the weekly performance, trying to encapsulate really three pieces of key price movement. And if I measure those up now, that's this one here, and that was when we had the lower CPI report out of the US with weaker retail sales, so again fueling that euro-dollar gain with that dollar weakness, but that also assisted the cable pair as well, managing to breach that 130 handle and accelerating to the upside. The next big phase then was that one. So on Tuesday this week, a lot of anticipation around the UK CPI reading. That was expected at 2.9%, so to remain constant from the elevation we had in the prior month. Actually, some fears that we might overshoot and breach 3%, given the fact that we had a 5-3 MPC split, the most hawkish we've had in about a decade in the June meeting. However, big surprise for the market, because the year-on-year headline reading came in at 2.6%. Way below expectations. Statistically, that deviation is pretty large for the CPI data, and so cable shot lower, reversing a large portion of those gains that were seen on Friday this time last week. Then the final kind of interesting part was what we've had with retail sales. Now, you've had UK retail sales report, and although it did exceed expectations for the month of June, it was predominantly down to abnormally good weather in the UK. As you know, we're not laden with particularly fantastic weather over prolonged periods of time in the UK, especially in London. But June was a bit of an exception to that rule, and good weather with the commencement of a new clothing season for summer, also the Eid festival. So these other kind of one-off seasonal time effects have actually led to the fact that people look beyond the strength of that specific month. And actually the bigger picture here for sterling is, if you look at the week in context of news flow for the Brexit situation, it certainly is not progressing at a very fast pace. If anything, it seems to be one step forward and two steps back when it comes to Brexit negotiations, and also the Conservatives' ability to manage their own party internally. So that, with economic data starting to show some weakness creeping into UK economic performance, you would say that going forward now, potentially that 131.53 that we hit towards the end of last week, and also just before the CPI data hit this week, might well be a pretty significant level that defines now what may be a downward trend going forward. You know, looking at cable, obviously that high that we hit earlier was putting us back to the highest level since September. Where we've recovered to at the moment, we're already back below that kind of May peak, and so maybe that's a pretty good point now to where we are. 131.53, 130.59, pretty good levels for upside resistance going forward, with the trend, most would imagine, probably Wall Street consensus is for that to decline going forward. I did see, though, what quite interesting, there was one bank that I spotted in the FT were quoting earlier today. Let me just bring it up. I did tweet it earlier in the session. And it's probably worth just having a look at, because even though I might have a bias of market direction, it's certainly, you've always got to be aware of what are the other contrarian views in the marketplace, what are the others thinking, the herd. And actually, there was this note out of MUFG, so I assume this is Mitsubishi Bank, and they're looking at 140, and the basis for the 140 call. Now, if we go back to, they're obviously going against what the broader market is looking for a push all the way back up to 140. 140, obviously a psychological handle. It's obviously a big retracement of the post-EU referendum dip, and it also defines the lows seen around April time, so a pretty good level. There's obviously some big psychological targets on the way, like 135, the big figures. But they're looking at this on the basis of they think that Theresa May, in effect, and UK government ministers will have to make big concessions and to basically secure a Brexit transition deal. And getting that deal done means ultimately a little bit of clarity for the near term for the UK economy and its businesses that operate. And therefore that should be a net positive, and therefore we could head to 140. So, that's what makes a market. Different opinions, but I'd say on the balance, most think that with the consumer under pressure in this current environment and context, that probably direction might be lower. But certainly this does mean, though, that the next Bank of England MPC meeting, I would imagine, is going to be a bit of, not a non-event, but certainly not as interesting as it could have potentially have been. For one, Christine Forbes, that hawkish member who had been for several months calling for a rate hike, she's no longer part of the MPC. So you're only left with two. So it'd be 5 against 2 now. So the case has become even less compelling, as well, with inflation obviously falling. And so the argument for hiking rates right now has certainly decreased substantially. Okay, finally, of course, got to mention Trump. Who knows where the next twist in the tail will come from. The initial reaction yesterday to the fact that the special counsel Robert Mueller in the US is going to be broadening investigations to Trump, that's prompted Trump to respond, according to the Washington Post sources this morning, talking about that his lawyers are trying to pin a conflict of interest case against Mueller. Talk that Trump might try to fire Mueller as well. I think that's a bit far stretched. But ultimately, what I think has been telling with the Trump situation is that I don't actually think that this is going to have too much of a material impact. And I think that because the negative reactions we tend to see on the back of Trump seem to be getting a little bit more shorter and shorter lived in terms of its impact on the marketplace. It's almost if, like with Trump's tweets, the market's desensitizing to the fact that he's going to be investigated going forward. That's just the norm. Whether or not this would lead to what will be the ultimate negative, which is impeachment, I don't think that's the case at this point. It would need to escalate a lot further. And obviously, though, if it did, equities have got a big correction on their hands if that ever did materialize. Okay, guys, it's getting a little bit raucous on the floor now. I think a lot of these guys want to get out and enjoy the weekend, so I'm going to leave it at that. Obviously, a good week. Had its peaks and troughs in terms of market activity, but have a good weekend, whatever you do. And then we'll see you again bright and early on Monday morning. Okay, guys, take care. Thank you very much.